Welcome to another weekly portfolio update here on The Last Investor. My name is Dan. I'm going to give you an update on my portfolio over this past couple of weeks. I'll then discuss this madness that's currently going on and why people are not being fearful, but are instead being greedy, and why we should consider doing the opposite. So please make sure you stay to the end of the video, as I'll also be sharing with you the best analysis I've heard so far on this Hertz fiasco, which I'm sure you've all heard about. But first, if you're new to this channel, thanks for taking the time out to join me. Please subscribe to the channel to help me get to 100 subscribers. And a big thank you to all those who have already subscribed. Really appreciate it. And of course, please don't forget to like and comment on this video. So let's get on into the portfolio update. First is CRISPR Therapeutics. It's up about 10% in the last 7 days, and it's really been doing very well. The most recent news on CRISPR Therapeutics is that on the 12th of June, new interim data came out on the clinical trials being carried out for beta thalassemia and severe sickle cell disease. Prior to the treatments, both sets of patients required blood transfusions between around 34 and 61 units each year, which is significant for anyone having to go through that amount of blood transfusion. But after they received the treatment, they were blood transfusion free, and so this June update is just to confirm that there's been no issues with the those patients who've undergone the testing. So the longer this goes on without any adverse effects from the treatment, the better it is for CRISPR Therapeutics, and really this is very positive news. And of course, I think that update in data pushed the price up a bit for CRISPR Therapeutics, and I can only see this getting better as time goes by. It's very likely that the price would go up over time as long as the positive news just keeps rolling in for them. But it's worth noting that there's another gene editing stock which is hot on the heels of CRISPR Therapeutics, and that gene editing stock is called Editas. Editas is very similar because it uses the CRISPR technology, but it does it in a very different way. I think it does it in vivos, which means it uses it within the bloodstream. So I think it would be some sort of medication that gets ingested, and that then releases the necessary enzymes that allow for the gene cutting to take place. So that's something that we should be looking out for. But nonetheless, I think both companies are very good, and in any event, I think CRISPR is far advanced in its testing stage, whereas Editas is only just at the very beginning, a very early stage of its trials. So anyway, let's keep an eye out for that. The next stock I have is Rio Tinto, which seems to have done very well recently, but I'm not really sure why, because the only news that seems to have come out recently for Rio is that there had been 2 ancient and sacred Aboriginal caves in Western Australia that were blown up accidentally, and this has sparked an outcry, and the Australian government has launched an inquiry into that. So one of its largest investors, an Australian pension company, has also threatened to sell all of its Rio stocks. Apparently it's worth about 115 billion that this Australian pension company owns. But it's not yet sold it. It's just simply wanting Rio to take some serious action to look into this issue. So we'll have to watch this space and see how this unfolds. I think this is one of the reasons why we have to be careful about mining stocks. There's so many variables, so many risk aspects to the actual stock itself. So it's important to bear that in mind when investing in mining stocks. So apart from that, the rest of my stocks seem to have gone just pretty much sideways. I think Slack, PagerDuty and Xilinx have gone up just very slightly, but other than that, most of my stocks have just gone sideways. Very interestingly, Carnival Corp It seems to have gone down even more in the last week or thereabouts, but I think it's gone down more than what it currently shows on this on Freetrade. But this is because it received some really dire news. Its quarterly results came out, and it shows that it's lost $4.4 billion in last quarter. Currently has 7.6 billion in working capital, but it's actually burning through 0.6 billion per month. So that working capital of 7 billion is probably not going to last it more than 12 months. So if this crisis lasts longer than a year, then the trouble is real for Carnival Corp. Only half of cancellations have agreed to rebook as well, so its reliance on its bookings is also possibly on shaky ground, because the rest of the other half have effectively asked for their refunds, for full refunds, which doesn't really bode well. Hopefully it will get through this, and let's hope that the cruising industry resumes sooner. At the moment, it's scheduled to resume around September, which is a pushback from the previous estimates of July, August. So it's been pushed back to September. Now, if this gets pushed back even further, and the longer it gets pushed back, the worse it looks for Carnival Corp. Let's hope it doesn't get to that stage. But I'll certainly be keeping a close eye on this one going forward. So as I said, in relation to my other stocks, I've started dollar cost averaging into the rest of my stocks, starting from the bottom. I've purchased around £10 each. So, except for BHP, which I had to buy £20 worth, because you can't really do fractional shares on UK stocks for some reason. The fractional shares seems to be only available for the American shares. So, other than UK stocks, I've actually been investing £10 per week in all of my other stocks. So I've invested £10 in all of my stocks, all the way up to Aviva. But the other ones I wouldn't be investing in, because obviously they've hit the 10% threshold. But I want to bring the rest of my stock up to that 10% threshold as well. So that's so that we could do it very, very gradually, and doing smaller amounts is also a way to manage the volatile times, because we really don't know what the market is going to do going forward. So by simply buying smaller shares over a longer period of time, then you smooth out that volatility. So that's what I plan to do. But at the same time, it means I'm still investing a significant amount of money, because per week I'd effectively be investing £120 per week into my individual shares. So on to the news of the week. The Nasdaq has reached a peak of 10,000, and in 2000 the peak was 5,000. And this is quite significant, because when we look at the Buffett indicator, this illustrates how serious this is. At the moment, on the Buffett indicator, it's an indicator which basically measures the total market cap to GDP. The theory goes that total market cap is all of the value of every single stock or company in the stock market, and all of the value of everything that they do should be equal to the gross domestic product. It certainly shouldn't be more than that. So it really, in theory, total market cap should be equal to GDP. But in fact, what we now see is that it's 146% of GDP. So it's literally over 1.5 times the size of the current GDP. And the last time that this happened was in the dot-com bubble, when it got all the way up to about 148% of GDP. So when you think of it that way, you can see that the market is seriously overvalued, extremely overvalued. The difference now is that we then have the all additional complications of COVID-19, the uncertainties that brings, and the very likely negative impact that this would have on the market as a whole, such as slowing economic growth, unemployment and bankruptcies. So this is something that we really need to watch out for very carefully. I think we should actually carefully consider the wise words of Warren Buffett, where he said, "Be fearful when others are greedy, and be greedy when others are fearful." And now is certainly the time to be fearful. But it's crazy to see how these markets run so high, and the loss of stocks are pretty much overvalued at this point in time. But yet people are buying them at record numbers. And this brings me on to the next point around the Robinhood trading and leverage. We have this really, really sad story about this 20-year-old kid who was options trading on the Robinhood app, and he thought he had actually lost about $730,000, and sadly he threw himself in front of a train and committed suicide. But what we now know is that apparently it was a glitch, and he probably didn't actually lose as much. We don't really know the full details. But nevertheless, this highlights the dangers of leverage trading. I cannot see any good that comes out of leverage trading, quite frankly. Even if you win big, it is unsustainable, because just like the casinos, the house really always wins. The stakes are so high, you lose very fast, just as you gain very fast. But you couldn't do that on a long-term basis. It's just not sustainable to actually try and invest that way. But it's simply not investment, it's simply gambling. And that's why really we're obviously, you listen to this channel, you're obviously going down the right track of being an investor and investing in the long term, or for the long term, rather than short term trading, which is a very short term view. And then finally, we have this very bizarre situation where companies that have already declared themselves bankrupt got their shares bid up so highly. It wasn't just Hertz company, it was also JCPenney, Pier 1 and Whiting Petroleum. So off the back of that, Hertz decided to capitalize on this madness and effectively issued the rest of its outstanding shares in the hope that this stupid money will buy the rest of it and basically give it money for free. You can't really describe how crazy this is, because these companies are effectively dead for all intents and purposes. They're not falling knives. Falling knives are companies that are struggling, but when a company declares bankruptcy, it's got to its end game. It's really right at the end. It's only very very few companies come out of bankruptcy, and that's very, very rare. And I think this video explains it really, really well. So let's take a listen.
Hertz filed for bankruptcy. Why did Hertz file for bankruptcy? The predominant reason why Hertz filed for bankruptcy is the business was hemorrhaging cash. It had all of these fixed costs and no revenue coming in. It was a bad business before COVID. It's a fiasco business post-COVID. Mm-hmm. And so Hertz had a terrible balance sheet. It had something like $16 billion of debt tied to the assets of the rental fleet. So in other words, they had pledged the rental cars as collateral for loans to finance the business. And that's very common. It's called ABS, asset-backed securities. But they also had $4 or $5 billion worth of real debt, unsecured by anything in the business, that they couldn't make the interest payments on because the business went away. Look, this is no fault to Hertz. COVID destroyed their business. This is what happens. I suspect, even in a post-COVID world, we're going to need a lot less rental cars because people aren't going to travel, because they've learned Zoom and they've learned how to work remotely and they've learned how to get things done without having to travel. So Hertz did the normal, typical thing that happens when a company can no longer service its debt. It filed for bankruptcy protection. Turns out, most of the times when you file for bankruptcy, the stock goes to zero. Why? Because during the bankruptcy proceedings, all the bondholders have to get made whole before any old equity holders see a penny. Right. But in the Robinhood era, a bunch of day traders spending their, Trump bucks, as we call it on Fitbit, have decided that they're going to buy and sell Hertz shares back and forth to each other and bid them up in what can only be described as a mania. And the Hertz debt holders who are currently in bankruptcy court, seeing what's going on with the old shares that are almost certainly worthless, have petitioned the court to sell residual unissued shares from the old company to these people who have no idea what they're buying to recover more money for the debt holders. And it's a sort of a nuance of Wall Street, and I know, your whole channel is about educating people about what actually happens on Wall Street and in finance. This is a real education for a lot of people. I think it's really amazing. There's almost zero chance that the stock currently being sold, new stock currently being sold by Jefferies, which is the investment bank that's leading the at-the-market offering of these unused Hertz shares. There's almost no chance those shares are going to be worth anything, and yet people on Robinhood are lining up to pay $2.50, $2, $1.80 for these shares that will eventually get zeroed out as part of the bankruptcy proceedings. And here's the proof. You can buy a bond in Hertz today that has basically priority over that equity that's being sold for 45 cents. Before the equity sees a penny, that bond needs to be made whole. I can look up on my Bloomberg terminal right now a Hertz bond, unsecured. It's selling for 45 cents. If the equity had any hope, that bond would be selling for par or close to it. It'd be selling for $1, not 45 cents. There's 4 billion of those notes, and if you just look at the value that the bond market is ascribing to those notes, it would put a negative value on the equity of, say, minus $2 billion. So what's going on right now is basically, in my opinion, I think it's totally wrong. I think it shouldn't have been allowed to happen. The Hertz debt holders are legally, overtly stealing money from uninformed retail investors.
Right.
And here's the analogy I would use. The way they get around it, the legal loophole they say, is we don't yet know how the bankruptcy process is going to unfold, and it's not yet certain that equity would be zero.
Okay, so the question then becomes, if we go back over the last 20 years, how many times has a publicly traded company filed for bankruptcy and the equity not gone to zero?
It's rare. It happens.
Okay.
But not with the situation like this. It can happen where things change and circumstances are such that there's money left over for equity holders. And in fact, it's not uncommon for equity to get something. It's typically called nuisance value to make everybody sign up for the final, negotiated package, and the new company's going to come out of bankruptcy with new stock. You might get 3, 4, 5, 6, 7 cents a share in nuisance value.
Okay.
But what's going on with Hertz is completely different. And let me give it to you in an analogy that I posted on Twitter that I think will resonate with your audience.
Yeah.
I'm going to put my hand in this register, and I'm going to grab as much cash as I can. It's not my cash. I'm a customer at a store. I'm at Home Depot, and they've opened the cash register. I'm going to throw my hand in that register, and I'm going to grab as many bills as I can. And then I'm going to walk out of this store. Now, since I don't know for sure that I might not drop a couple of dollars on the way out, I can't say with certainty that I'm stealing or how much I've stolen. But that is effectively what's going on with Jefferies and the Hertz debt holders. They see idiot retail investors who don't know what they're doing. They see the stock being bid up by the Davy Day Trader global types and all the people that follow them and all of the high-frequency traders that are front-running those trades. And they say, hey, we have over here 247 million shares of Hertz that we never issued. The stock is trading for a couple of bucks a share. Our whole might be $5 or $6 billion, but if I could sell that 250 million shares for $2 a share, I could steal $500 million from idiots and give it to the bondholders. And that's what they're doing. And it's overt. It's right in their perspective that the issue today. It is historic. It is unprecedented. It is insane. I can't believe it's happening. On the flip side, somebody else DM'd to me, hey, the quicker this $500 million gets pulled out of dumb money and into smart money's hands, the quicker we're going to resolve this mania. Because that's what they're doing.
Yeah, it's always capital goes where it's treated best.
That was absolutely incredible. I mean, the way he broke that down, really, it just sums it up. You've got people buying shares in a company that can't pay its debts. The debtors who the company owes are at the moment unable to get all of their money back. I mean, the debts are selling for 45 cents, which are actually worth £1. They're actually selling for 45 cents. And they're the ones who will get their money first before these equity holders. And this is one of the things that people don't really understand around debt and ownership, is that people who own a company, they bear all of the risk in the company, and people who don't, and people who lend money to the company, who are creditors of the company, it's less risky and they don't bear all of the debt. The quality of debt also varies. You've got secured debts and then you've got unsecured debts, and the secured debts always gets paid first, because if necessary they could liquidate the company and basically have all of the assets of the company sold, and whatever is left after all the assets in the company is sold, those secured debt holders get their cut first. They get all of their credits paid off first, and then whatever's left over from that asset gets paid over to the unsecured debt holders, and then whatever gets left over after that gets paid to the equity holders. And in reality, in most bankruptcy situations, for the very mere fact that they can't pay their debts, there's rarely ever enough money or assets left to pay off the unsecured debtors, let alone the equity holders. But yet you've got these fools who are buying into and putting money in, thinking they're going to get money out. Now, obviously, some people may have been lucky. They bought in at the very start and they sold off very quickly at an earlier stage. But you still got some people who are holding some of these shares, and if they are, because it was at its lowest point, it was around 0.56 cents, so it was around 56 cents. But now it's currently trading at $1.73. So you've got to imagine that there's still some people who are holding this share, thinking or expecting to get something out of it, and the reality is they're not going to get anything out of this. You know, the likelihood is they've probably lost their money. They're not going to get anything out of this. So that's just a lesson for everyone, just to beware. And it really just goes to show how much mania there is in the market. And the more the people who are very new into this, who don't really understand the pitfalls of the stock market, they're the ones who get burnt very quickly. It's really sad when this happens, but yes, just be careful out there, everyone. And if you're new to the stock market, then you need to make sure that you understand it very well, understand what you're doing, make sure you invest in the right companies. Anyway, I'll leave it there. Thanks very much for watching, and of course, remember to subscribe, like, and comment. Peace.